Welcome to TheoTrade and the weekend update. My name is Don Kaufman. It is May 8th, 2016, and we are going to start by looking at a comparison chart here of the SPX, the NDX, and the Russell on a year to date. So let's just kind of, again, do a little reconciliation, if you will, of where the markets are kind of year to date and where some of our broader markets happen to be in comparison to one another. So I'll go through here and just kind of highlight, if you will, which is which. If you're not familiar with looking at a comparison chart, get familiar with it because it's something I use quite often. Right here is our primary product, this being the SPX. All right, second in command over here happens to be none other than the Russell, and last but definitely not least is the NDX. Okay, on the right-hand side of the screen, you're actually looking, all right, at percentage, and that is year to date. So I kicked it off by looking at a year to date. So to give you a little perspective, the SPX, which is the S&P 500, is up about 2%. The Russell is relatively unchanged on the year, and the NDX, who's the big loser in the pack? Well, technology, which is down almost 4% on a year-to-date basis. So the reason that I mention this is, again, I very frequently look at convergence and divergence of given products to get a better feel for the overall market. Here, I just wanted to give you a perspective, again, where we are kind of year to date, given the fact that, all right, we're coming into the halfway point of the year. Can you believe it? I know we're only in May right now, but it kind of feels like, all right, June is right around the corner. We're halfway through. Indices have done nothing, but they've thrown off quite a bit of volatility in the front of the year. So at this point, okay, forget so much about what may have occurred last week, right? You got to be, again, forward-looking at all times in a marketplace, and that's really what I'm going to try to give you a little bit of insight to. So let's go ahead, kind of blank the screen over here again. That's just a little perspective on where indices have been year to date. What does this look like, though? Again, on a broader kind of scope, broader comparison, and you're going to see the overperformance, all right, over the last 3 years inside of the NDX, which is the Nasdaq 100, is still staggering versus the S&P and, of course, the Russell. And that's why I like to start off with like a year-to-date comparison, because all that you're seeing right now is a normalization, if you will, of the NASDAQ having this amazing overperformance, okay? And that's over and above, of course, the S&P, over and above, of course, the Russell. And you'll see throughout history that these products do converge upon one another. Now, the reason I bring this up so frequently here at TheoTrade, this is what matters. This, okay, is signaling, is volatility coming? Do you think the NASDAQ, all right, can actually descend into the S&Ps and the Russell without it throwing off substantial volatility to the rest of the market? That's the question you have to be able to answer, okay? For me, it's most decisively absolutely not. And again, when you start looking at this in tighter time frames, and look at like here's a 3-month, okay, this is just a 3-month, and I like to always look at comparison charts in multiple time frames. Listen, I'm not a market technician. I'm much more of a quantitative trader. People, it's a quant. It's become like a label out there. And for me, to look at a comparison chart, it's much more a measurement, okay, a statistical measurement of one product versus another. And I often look again at convergence and divergence, and that happens to be the distance, if you will, between, all right, the major indices. Because again, every stock that's on this screen, and I know people, well, they want to, what about Tesla? What about Tesla? You think that's going to get through unscathed if the NDX comes down bigger? All right. What about any individual product over here? And again, Google, it's my obsession right now. Google really is. It's one of the obsessions I've got. But it's more important to look at the broader markets. And when you use comparison charts, you must use multiple time frames, 3 time frames at minimum. We started with a year to date. Then we jumped to like a 3-month. Okay. And then we've also looked at like a 3-year. In 3 years, you see this monstrous outperformance. Okay, over the last 3 months, all of these major indices are up. I picked 3 months because that's pretty much when the rally ensued. But the NASDAQ underperformance. Okay, what it's telling us, again, on a much broader time frame, what it's telling us is that there is a convergence underway. And that convergence, and that is this NDX coming down to the SPX, or vice versa. The SPX could actually come up towards the NDX. The entertaining area is, right now, both of those are happening. Okay, right now, when you start to look on a 3-month, you'll see the SPX in many cases outperforming the NDX, all right? And the Russell, the little engine that could, outperforming them all over here. So we watch, all right, ultimately one product versus another and one major index versus another to get a feel for, are we still in the midst of volatility? And the answer, okay, quite clearly by looking at these, again, the convergence, the divergence. Okay, if you're not comfortable with those terms, that's fine. In a broader scale, all right, if you look at the overperformance of the NDX and how it's now ultimately converging upon the SPX, the answer is yes. We are still in the midst of an extreme volatility cycle. Even though we've seen what we would call like the big rip your face off rally, the SPX just took off by 300 points to the upside. Okay, nevertheless, we sit, we wait, right? Wait for what? The reality, okay, here is just the S&P, and I just wanted to clean the chart for a moment here. Here's the S&P over the last 9 months. What's it done? Absolutely nothing. But again, to a broader scale here, we even bring up a 3-year, okay, and you're sitting in the exact same kind of inflection point. And here we go all the way back into mid-2014, something else I've pointed out substantially. So the reason I bring this up is because, you know, there's not any technicals here to really assist you. And, you know, more perplexing is just what we've seen in the last few trading sessions. And I want to point this out because, again, the market, you're always looking for tells out there. Okay, signs, if you will, of volatility. So we have this 300-point unstoppable upside move. What's even more curious is kind of a low volume sell-off that we've seen over the last, all right, here we go. All right, you're coming into now 3 weeks. We've got this low volume sell-off. And a low volume sell-off, you realize in the peak of this, the S&P futures only did like 2.5 million contracts. It's actually light. Because, again, to give you a little bit of perspective, you want to see some sell-side activity and some good down days. You want to see the S&Ps throwing off at least 3 million contracts, which you did time and again, all right, back there. So we're seeing this low-intensity, kind of low-volume sell-off in some recent trading sessions. And if you are, again, kind of a market technician, all right, believe me, I know my technicals. All right, whether I use them or not is a different story. What I have noticed, though, in day-to-day is take a look at this. And most sell-side activity, you actually get the intensity towards the end of the day, and we end close to the end of the day. All right, towards the bottom of the candle at the end of the day, which, for those of you that are into candles, would be something called a Maribozu. That is a wickless candle, all right, which we close to the lows. In each of the consecutive trading sessions where we've actually made, you know, lows over here and we continue to head a little bit lower, you realize every single day we've rallied off of those lows. What we're going to be looking for inside just the next few trading sessions here, okay? Are we actually going to break lower? Are we going to close towards the lows? Are we going to see intensity to trade? There's a reason, all right, that volume, again, is so light. And the volume is light on days, again, and this is a fairly substantial move. This is a 20-point range. This is a 20-point range. This, okay, happens to be what? A 25-point range. So we're putting off 25-point range, 20-point range, 20-point range. Here we go, 20-point range. And there's a reason I'm pointing out what the ranges are on a day-to-day basis. Bear with me for just a second. But we're not putting out intensity. We're not putting out volume because we're not closing towards the end of the range. So why do I mention the ranges? Every single day we're seeing at least 20-point to 25-point ranges inside of the S&Ps. The reason I point that out, if you go over to the SPX, and again, we want to get a feel for what the markets are going to do this coming week. And I bring up the SPX here, and I look over, and I just close up this left side bar, and I look over all the time to the right-hand side of the screen, and what you're getting here are these are what implied volatility are saying about risk out there. So the volatility in the 5-day, and this is it, that's just 5 days, right? That's just covering this coming week. They're only pricing the move to be $29 and change. And yet, on a day-to-day basis, we're seeing 20-point swings. Now, do you think, as a trader, that it is worth selling options in a really, really short duration? You got to realize this implied volatility right there, that impacts every product you're going to trade, from Apple to Google to everything. Do you think it's bright to want to sell premium when they're only going to pay you $29 for the entire week? And yet you're seeing 20, even 25-point moves every single day. I don't like it. I won't touch it. Okay? I'm not selling this short duration premium. And again, you guys have heard me mention this again and again and again and again. So I even went back to last week. Okay? Here we are last week. So what did I do? I went into a piece of technology called ThinkBack. I backed up the date to last week. That's it. Okay? This is end of day data. And what did I want to look at? It was just, well, last Sunday. And last Sunday, what was the expected move? It was about $33. Okay, so last week we had a $33 expected move with the the SPX trading at 20.65. Now, again, bear with me here. I'm going to open up that left side bar. The S&Ps, you realize, like, if you looked at the chart and you're like, oh man, it was a big down week. Was it? Last Sunday, we were at 20.65. Okay, here we are this Sunday, 20.57. You look at a chart over here, you're pretty much convinced. You're like, the end of the world is coming. Here's 1, 2, 3, 4, 5 days. Okay, what do we do? Absolutely nothing. It's a 10-point move. So yes, we are fading here, and it's a low volume fade. We want to look this coming week for intensity in trade. Okay. What are some of the warning signs that you want to look for? Right now let's talk about some equity products. The one that has got me, again, infatuated, okay, happens to be Google. So I am watching Google throughout the entire coming week over here. And the reason I'm watching Google, it's already towards the depths. And I do watch Google L. It's towards the depths of where it was back in January and February, okay, in the depths of the marketplace. In terms of a Nasdaq product, Google has fared extremely well. Its market cap is spectacular in size. Okay, Google cresting under 700 devastates the market. To me, that's the sell side activity is here. Put your helmet on. We're going in. Apple, okay, if you want to take a look at Apple, it's already broken down. That's what's causing some of the pain inside of the Nasdaq. However, Apple is quite entertaining right now. It too sits exactly at the depths of where it was, okay, back in January and February when the market was getting absolutely punished over here. The only difference is Apple on a day-to-day basis just keeps slipping lower. Similar though, okay, what I would call kind of a lower volume, if you will, sell-off in there. Those are two key products. Now, two key products, and I'm giving you kind of marquee numbers. Inside of Google, 700, right? That's you know, the line in the sand, if you will. Inside of Apple, I think you look at Apple at $90. Okay, you look at Apple breaking under 90 can be catastrophic for the rest of the market. Again, market cap and these two underlyings matter. People are still infatuated with Facebook. There's just a rotation of capital out of Apple, okay, into Facebook over here. Again, it's pretty decisive as you look. It almost looks like an inverted chart, if you will, of Apple out there. Now, two other areas of concern as we come forward into this week. The XLF. All right, the XLF is definitely breaking down a little bit. However, this, okay, most recently is a strong candle over here. This is actually, it's a form of a bullish Maribozu for those of you. It's almost a wickless candle. Yes, I know my technicals, but it's actually a little bit of bullish sign. You want to watch the XLF as the week progresses carefully. All right, energy, well, it's been all over the place. Why, again, do I pick on the financials? So we talked about Google. It's going to move technology. We talked about Apple. It's going to move IT. Yet the biggest sector, all right, that can really be the market mover and has really been at the forefront of some of the selling here recently has been the financials. All right, we already know that there's, punishment going on inside of many of your technology companies. Financials, though, have felt the brunt of this recent sell-off over here. Now, this really relates, and I said there's two other products to look at. This relates heavily to the bonds. Now, some of you are not really comfortable looking at the ZB, okay, or the ZN, and those are the actual bond future. So I digress, and I go to the TLT. Right now, TLT got me nervous. What does the world seem to know, and why are they buying bonds? Okay, and this is not a low volume trade going on. It's quite the opposite. All right, in some cases you can make an argument that the volume in here is pretty good. It's getting it done. Again, to give you a little bit of perspective over here, inside of the volume world. Okay, here's back in absolute insanity. All right, here we currently are, but we saw some heavy volume spikes being thrown off inside, again, of the bond market. The TLT, I don't think it necessarily does it justice. There was actually heavy trade in the notes and the bonds throughout the course of the week. Again, you see these peaks well above some of the recent trade that we've seen. So why do I always look at the bond product? Let me tell you something. Bonds, they move markets. They move markets. All the major financial institutions today, they cannot take directional positions per se in individual equities, and they can't take directional positions inside of the broader S&Ps. Now think about what I just said for a second, because I want to be really crystal clear about this. Right? As part of financial regulation, right, the Dodd-Frank bill, there's actually a specific portion of that regulation. Okay, you guys can look into this a little bit. It's the Volcker rule. Most of the financial institutions, even though the full legislation has not necessarily come into effect, almost every one of the financial firms that is labeled, quote unquote, too big to fail, which is everybody pretty much out there that you've heard of, from the JP Morgans to Goldman Sachs to Merrill, which is Bank of America, to, Morgan Stanley, and on and on and on and on and on and on. Did I miss anybody? Of course I did. All right. But some of them are long in existence. They trade the treasuries, the U.S. treasuries. Okay. Part of the Volcker rule says they can't take directional risk inside of the S&P. Okay. They can only do what's called bona fide hedging activity. So if somebody like JP Morgan trades Apple, they can't take a big directional position. They can only do what's called bona fide hedging activity. It means they can mitigate their risk and they can trade and make markets in it. However, one of the things that is not covered inside of the Volcker rule, they can trade all the treasuries they want. They can take the biggest financial risk they want in the treasuries. Right now, you really better look at the treasuries. Okay? Because again, they've rallied huge. All right? Faded, rallied huge, faded. Now, they're poised to possibly break out, okay, to not just highs. We're talking all-time highs over here. You want to pull up a bond product for how many years? You're going to see explosive moves. Why is the world going into a duck and cover position? Why are they buying treasuries, okay, and continue to buy treasuries? And I have to tell you, every time you see the treasuries move, kind of get the little lump in the throat over here, and I'm like, what do they know? What's going on? Because again, these banks, they show their hand in the treasuries. They can't show their hand inside of the S&Ps over here. However, this is the way that they would say, hey, I'm buying up volatility. Think about it. This entire week, again, there's a low volatility, all right? That kind of an eerie low volatility inside of the S&Ps. The S&Ps, last week to this week, they only moved 10 points. Keep it in mind as we go along. It's, again, could be some volatility this week on an intraday basis, okay? Could be some volatility in an intraday basis this week. Look, again, towards some major products. Google, 700. Apple, to recap, 90, all right? Absolutely watch the XLF, because the XLF, it's going to be impacted by none other than what the bond market does. Again, the next major move in markets is being marked by movement inside of the bonds. Thanks a lot, everybody, for joining me here on the Weekend Update. I am Don Kaufman. Be back on all this week. Have a good trading week. Bye-bye.